Gold and silver, two of the world's most valuable and sought-after precious metals, have long been considered reliable stores of wealth, especially in times of economic uncertainty. Over the past year, both metals have experienced a remarkable rally, reaching significant highs driven by several influential factors. Central banks around the globe have increased their purchases of these metals as a hedge against rising inflation and economic instability. The geopolitical landscape has also played a major role, with escalating tensions in regions such as Eastern Europe and Asia, pushing investors towards these traditional safe havens. Additionally, the sustained decline in global interest rates has made the opportunity cost of holding non-yielding assets like gold and silver more attractive, further boosting demand. Despite this bullish trend, the market for gold and silver has faced a recent and notable pullback. This decline came as a surprise to many investors, but analysts like Mike Maloney had anticipated this move, referring to it as a necessary retracement after a period of unsustainable growth. Maloney points to historical patterns where sharp price increases in precious metals are often followed by a temporary correction, a natural reaction within any financial market. He likens it to a slingshot effect, an initial surge in momentum that propels prices upward, only to be followed by a brief reversal as the market consolidates gains before resuming its upward trajectory. The recent market decline can be attributed to shifting economic policies and changing investor sentiments. Concerns about the U.S. economic outlook, particularly surrounding the proposed tariffs and immigration policies of former President Trump, contributed to a more cautious approach by market participants. The fear of increased restrictions on trade and labor movements led to expectations of a more restrictive U.S. monetary policy, which in turn dampened the demand for gold as a hedge against economic instability. The result was a notable drop in gold prices over several consecutive trading sessions, bringing the metal's value to its lowest point in over 2 months. However, this pullback does not indicate a broader bear market for gold and silver. Instead, it is viewed as a temporary correction within a larger, sustained bull market. Mike Maloney remains steadfast in his optimistic outlook for precious metals, arguing that the fundamental economic conditions that drove prices higher in the first place have not changed. On the contrary, the underlying issues such as persistent inflationary pressures, economic distortions from central bank policies, and heightened uncertainty in financial markets are expected to continue, providing strong support for gold and silver in the long term. One of the key drivers of this expected upward trend in precious metals is the Federal Reserve's monetary policy. Over the past 2 decades, the Fed has adopted a consistent playbook in response to economic downturns, lowering interest rates to near zero and increasing the money supply through quantitative easing, QE programs. While these measures are designed to stimulate the economy and boost consumer spending, they have also led to unintended consequences, including the inflation of asset bubbles in the stock and real estate markets. Maloney argues that the Fed's actions have created an artificial sense of economic stability, masking deeper structural problems that are likely to resurface once the effects of monetary stimulus wear off. The Fed's strategy of maintaining low interest rates has had a profound impact on the broader economy. By keeping borrowing costs low, the central bank encourages both consumers and businesses to take on more debt, leading to increased spending and investment. However, this approach also creates a dependency on cheap credit, making the economy vulnerable to any future rate hikes. When interest rates inevitably rise, as they must to combat inflation, the sudden increase in debt servicing costs can lead to a sharp slowdown in economic activity, triggering a recession. Maloney highlights this cycle as a critical factor that will drive investors back to safe haven assets like gold and silver. The Federal Reserve's aggressive monetary policies have also contributed to the inflation of asset bubbles, particularly in the stock and real estate markets. As the central bank pumps more money into the financial system, the excess liquidity often finds its way into these markets, driving up prices beyond their fundamental values. Maloney warns that this artificial inflation of asset prices cannot be sustained indefinitely. When these bubbles burst, as they did during the dot-com crash in 2000 and the global financial crisis of 2008, the resulting market turmoil often leads investors to seek refuge in gold and silver, driving their prices higher. The COVID-19 pandemic provided a stark example of the Fed's approach to economic crises. In response to the unprecedented economic shock caused by the pandemic, the central bank implemented massive stimulus measures, including slashing interest rates to near zero and launching extensive QE programs. The scale of the Fed's response was unlike anything seen before, with trillions of dollars injected into the economy in a matter of months. Maloney notes that the magnitude of this monetary expansion was comparable to the combined efforts of several previous QE programs, compressed into a much shorter time frame. While these actions helped stabilize the economy in the short term, they also set the stage for future inflationary pressures, which are now beginning to manifest. Inflation, which had been relatively subdued for much of the past decade, has started to rise, fueled by the increase in the money supply and supply chain disruptions exacerbated by the pandemic. The Consumer Price Index, CPI, a key measure of inflation, has shown significant increases, prompting concerns about the potential for runaway inflation. Maloney argues that the full impact of the Fed's monetary policies may not yet be visible, as there is typically an 18-month lag between increases in the money supply and the appearance of inflation in official data. As this lag effect plays out, he expects inflation to accelerate, further enhancing the appeal of gold and silver as hedges against the eroding purchasing power of fiat currencies. The outlook for the future of precious metals is closely tied to the Federal Reserve's next moves. Fed Chair Jerome Powell has indicated a cautious approach to adjusting interest rates, suggesting that the central bank will continue to prioritize economic recovery over immediate concerns about inflation. However, with inflation remaining persistently above the Fed's 2% target, there is growing pressure on the central bank to take more decisive action. Market analysts anticipate that any further rate cuts or delays in tightening monetary policy will provide additional support for gold, potentially pushing prices to new highs. Maloney believes that the economic distortions created by the Fed's response to repeated crises, including the extensive use of low interest rates and aggressive currency expansion, have fundamentally altered the financial landscape. He argues that these policies have not only inflated asset bubbles, but have also distorted market signals, making it difficult for investors to gauge the true health of the economy. As a result, he expects the boom and bust cycles that have characterized the past 2 decades to continue, with each new crisis leading to an even more aggressive response from the central bank. This pattern, he suggests, will create an environment of increased volatility and uncertainty, driving investors towards safe haven assets like gold and silver. In conclusion, the demand for gold and silver is likely to remain strong as long as these systemic issues persist. The underlying economic conditions, rising inflation, monetary policy distortions, and geopolitical uncertainties provide a solid foundation for a sustained bull market in precious metals. As traditional assets, like stocks and bonds, face increasing risks, more investors are expected to turn to gold and silver as a means of protecting their wealth. Maloney's analysis suggests that we may be entering a period similar to the 1970s, characterized by alternating periods of economic growth and recession, but with even more pronounced volatility due to the unprecedented scale of recent monetary interventions. The potential for new highs in gold prices is supported by several factors: the continued accommodative stance of the Federal Reserve, the increasing risk of inflation, and the broader economic instability exacerbated by policy decisions. Analysts are forecasting that gold could reach $3,000 per troy ounce by the end of 2025, driven by persistent demand and a lack of confidence in traditional financial markets. For investors seeking a hedge against inflation and economic turmoil, gold and silver remain attractive options, providing a reliable store of value in an uncertain world. As we move forward, it will be crucial to watch the actions of the Federal Reserve and the broader macroeconomic trends. Any shifts in monetary policy, changes in inflation expectations, or significant geopolitical developments could impact the outlook for precious metals. For now, the consensus among experts like Mike Maloney is clear. Gold and silver are poised to continue their upward trend, offering a safe haven for investors looking to navigate the challenges of an increasingly volatile and unpredictable financial landscape.